to our third webinar on exchange traded currency futures. Before this, we had covered introduction to currency markets, where we had talked about the entire journey of how currency came into existence. We had talked about the Bretton Woods system, gold era, and then sort of moving from that into a market wherein currency was largely determined by market forces. So that was largely the introduction to currency markets. Post that, we had moved into FX derivatives, wherein we talked about the basics of FX derivatives. So we had touched upon how big the size of the market is, what are the types of instruments. We had talked about bid ask spread. We had talked about currency pairs, so on and so forth. Now we move into the third piece, which is the third webinar, which is exchange traded currency futures. And this particular webinar, let me tell you, is a short webinar, but a scoring avenue in case you want to sort of maximize on your marks for your examination. So bear with me, concentrate, and please feel free to put across all your questions through the comment section, and we will go live with our third webinar, which is on the currency futures. We can move on to the video, please.
Welcome to our third webinar. With the basics of derivatives covered, we'll now move into currency futures. Let's recap on what we already saw in the last webinar on currency futures. Let's move straight into the features here. Futures contract is a bipartite agreement between the buyer and the seller. The futures contract is traded on the platform, which is the exchange. This also implies the buyer and seller do not know each other personally and are not aware about each other's specific involvement. A future contract is also left for price discovery to happen through market forces, that is between buyers and sellers. Margins are maintained on both sides since this particular trade is guaranteed for settlement. From a risk management standpoint, these margins are to be maintained such that not either of the parties is out of pocket while settling. The terms for a futures contract are also standardized to the extent that the expiry date is well known, which is the date on which you will be settling. The quantity for which the buyer and the seller have been paired together is well known, so on and so forth. There are also concepts like the strike price, also written as X, to be predetermined and be well known. We'll be covering some of these concepts in the next few slides. Look at some key terms for the futures. First one is the underlying asset. The underlying asset refers to the currency in which you will be trading. This is always vis-a-vis INR, since we are referring to currency futures in India. Other than the major currencies, this can also involve other currencies through the use of currency pairs. This goes back to the point where we discussed about exotic pairs, about cross rates. This is the concept of how we would derive quote which is not directly available, but using two quotes you would try and get to another quote which is with a non-major currency. The spot price or the rate refers to the existing pricing for the underlying asset or the currency pair that you are referring to. So this is your current pricing for the trade. A future price, or in other words, this is also known as the strike price and is also oftentimes written as X, is nothing but the price at which you are going to be trading at a future rate. So this will be the price at which you enter into a trade for a future contract. Quotation is the price that has been quoted for that specific underlying. In this case, which is USD INR, we are quoting a price for 1 unit of USD. Likewise, for JPY INR, there's an exception here that the JPY gets quoted for 100, or rather, the JPY is quoted for 100 units of JPY rather than 1 unit of JPY. The contract cycle could be any of these: weekly, monthly, quarterly. In fact, if you were to look at the open interest as a concept and on the exchanges, you will come across the long and the short of the open book, and then for every strike price and with a frequency or the contract cycle, we would have an entire table of information around what has been the premium and what has been the bid and ask for those contracts. Finally, coming on to the expiry date. Expiry date is nothing but the date on which you expect to settle your trade. This is the day when you would expect your future price to tie back to the prevailing spot price at that time to avoid any arbitrage situations. Let's get into some more futures terminology. What's the tick size? The tick size is the minimum price difference between the current price and a price that you wish to push across as a buy or a sell price, the difference between the current price and that price. So if for USD INR, say the USD INR code right now prevailing is 89.8700, then upwards or downwards by the tick size is the price that you need to push in for the price to move, which is in this case the price which you can push across in the system would be 87.25 and 86.75. The contract size over here means what is the size of a single contract for every commodity or for every currency. The lot size is defined differently. For USD, it is 1000 USD, which becomes a lot size, which is a single contract. For contract value and price band, you are allowed a particular band in which you can put in your quotes for buying and selling. Now, this is a percentage up or down to the current prevailing price. This ensures that there are no erroneous entries which come up on the system. So if, say, let's pick up the previous example. If the pricing is 89.87 and 87 and you are allowed a 1% entry which is upwards or downwards, we will be allowed an entry which will be on the buying and selling side, upwards at 1% or downwards at 1% for putting that order into the order entry book. Right? Now, base price is your reference price for trading. For that specific date is the theoretical future price, but for any subsequent day, it's the settlement price for that day. These trades require daily valuation or revaluation, which means if there is a price movement in favor or against your current position, you are supposed to bring margin. You'll have to bring margin if the price movement is against the call that you have taken, or your margin will get released in case there's a movement in a favorable movement in the price of the futures contract. Derivatives markets are also known as shadow markets to the underlying. to the underlying. Sorry, my pen. Yeah, to the underlying. Now, what does that mean? Say theoretically, if there is 100 kgs of gold in this world, there's a particular amount that is allowed to be traded in the derivatives market. Oftentimes, you can say this is around 15 odd percent, which means the derivatives market cannot have trades in excess of 15 kg. So that's your open interest limit. And open interest by the mere term, it means the of volume of outstanding contracts for that specific underlying.
So we had received feedback that the audio quality on the first webinar was not good, and we sort of tried to take control and come up with a better audio quality. If there's any sort of feedback which you wish to provide to us, please feel free to push it across, be it content wise, be it something that you feel that should be covered in the future webinars. We will try our best to cover that in. Additionally, I think perhaps either I'm doing a very good job or perhaps a very bad job, but I would love to have some of your natter, some of your questions. If something is not clear, please feel free to push it across to us. We'll move on to the second video.
Futures contract, or rather a currency futures contract, states clearly some of the contract specifications. This would mean that what is the underlying in which you're trading has been put up clear. As mentioned, one contract, as mentioned in the previous slide, one contract, the size of the contract is also defined that this is a contract, and the number of contracts for which a person trades is also made clear within that agreement, within that sort of order book. The price quotation is for either 1 unit or 100 units is also mentioned in the futures contract specification. A cycle that you will be getting into is determined and mentioned as one of the standard cycles prevailing for the currency trades. The trading hours are defined when trading is permissible to happen over an exchange. This varies based on whether the currency pair is with a major currency or is with a minor currency. Other specifications of a futures currency contract: expiry date. This could be either be weekly, monthly, so on and so forth. The date on which this contract will expire is predetermined, with the 2 working days prior to the last business day of the expiry month. This is for a currency contract, by the way. Or if it's a weekly cycle, then it's every Friday at 12:30 p.m. Likewise, these futures contracts or on the currency are cash settled and not currency settled, in the sense that in case you get into a USD INR, you need to basically pay or receive straight away the settlement price based on mark to market, and you're not supposed to deliver the hard currency. The final settlement price is taken up based on the FBI reference rate on the last trading day. Settlement timelines: if the daily settlement cycle is say T+1, the final settlement would happen on T+2. This goes back to the concept which we initially talked about, which is futures contract has to be settled beyond the contract for the spot settlement, right? So if spot is getting settled, or rather the typical cycle for a spot settlement, if it is T+2, then a futures settlement has to happen at T+2++. As for price bands, you can put in So the price bands would change based on the tenor for which you are picking up the futures contract. So for the first 6 months, if the contract is for the first 6 months, the band allowed is plus or minus 3%. Likewise, if the contract is even longer dated, then the price band involved is for plus or minus 5%. Let's wrap our heads around the positions in derivatives market. Now, a long position basically means you have purchased the underlying. So you would make a gain when the price goes up and make a loss if the price goes down. Likewise, the short position is absolutely the inverse of a long position, wherein you will make a gain when the price goes down and make a loss when the price goes up. An open position is the position that you are currently holding on to, and might be that this position could be a combination of a long and short. Now the example on the screen over here says that you could have short five futures contract on USD INR and buy three futures of Euro USD. Your open position is nothing but your shorting of this and being long on Euro USD. But to explain this concept even better, say if you were short 5 USD INR and after a few days you went long on two for the same future specifications, you went long on 2 USD INR, then your open position for USD INR would be 3 USD INR short, because your open position is net of shorts and longs. Finally, what's opening and closing a position? When you enter into a particular futures contract, either by buying or selling, that's known as opening or closing a position. Now, similar to the specific trade wherein you had netted out 2 USD INR by going long on this, what you have done is you have closed your position of 2 USD INR because this was a contra trade to, so this was long as per the previous example, and this was a contra trade of 5 USD INR short to the extent of 2 units. So you closed out on 2 units of USD INR in terms of your position, and your open position on this is 3 units of USD INR, and since this is short 5 units, this is short 3 units USD INR. The payoff of a futures contract is linear to the price movement, which means, say if the strike price was here at 100, this is what I'm putting a dot at 100, you would make a gain of 1 rupee when the price is 101. So simply put, this is 45 degrees. That's the linearity which I'm talking about. So you would make a gain of a rupee when the price moves up by 1 rupee, when the strike is at 100. Likewise, if this price reduces by a rupee, which is, it's at 100, it goes to 99, you would make a loss of a rupee. Now, to explain short, I will use a different colored pen. It is similar that you would have say the strike at 100, and in this case then you would have a gain of 1 rupee in case the price went down by a rupee 200. So if the price went to 99, you would have a gain of a rupee. So this line for a short futures contract would be something like this. And likewise, you would make a loss if the price went up 201. You would then make a loss of a rupee. So this particular angle here, for all those people who are fascinated by geometry, would be a 90-degree to explain the linearity in returns for a long and a short futures. The contract value in INR determined for a currency future. So first of all, this number that we see over here, which is USD INR, represents 1 unit of USD and the pricing to be say 83. Now since the contract size is 1000 USD, you simply multiply the two, gives you the price for 1000 USD for this particular quote, right? Now in case you have a cross currency pair, in that case you first of all find the quote in USD terms with a similar concept here. So 1 unit of euro is priced at 1.08 USD. So 1000 euros would be cross multiplied and be priced at 1080 USD. And then based on the prevailing rate of USD INR, you would come to the number for INR in terms of contract value. This is the approach when you're using cross-currency pairs.
I see a question around who defines the value of tick size. So the tick size, because it gets traded on the exchange, the tick size is basically defined by the exchange because they are governing all trading activities happening across currencies and across the cash segment as well as the derivative segment, right? So the tick size is defined by the exchange. Second, just in addition, wanted to share more information around that is, you have a quote, especially in USD INR, wherein, currently it is 91 point something. So it gets written as 91. Let's assume it's 91.50 paise. So it gets written as 91.5000. Now, in that case, 91 is your rupees. That does not change. But 0.50 basically represents basis points. It's this term gets used also in interest rates in a lot of places, that the first two decimals are known as points, the last two decimals, which is of that 4 decimal number, which is 92.5000, the 00 are known as pips. So if someone says and they already know the numbers well, they would simply quote the pips and not quote the points. So that's the conversation. So that's the breakup. 90 is your rupees. First two decimal represents points and the next two decimal represents pips. So that's around your currency and the tick size. I also see questions on feedback on getting to use more examples. You'll certainly see this series to have a lot of examples also put in between wherever we can sort of weave in an example in any form. So for example, Seema, you will see that we gave an example of what happens when you open a position, what is a closing a position. We had given numerical examples there. We will try incorporating as many examples as possible, understand the feedback. And finally, I think there's a question around on short position. I think Bhagwati wants to understand that a little bit more clearly. So let me, make an attempt here. So see, before getting into the short position, let me just explain what is a long position in very simple words. One, see, a long position is nothing like it's as simple as you sort of going to a shopkeeper and saying, you know what, I want to purchase that toy for my kid, but I will purchase it on next month when my kid's birthday is coming in. And you say, I will purchase it at this price. Now, in very simple words, this is nothing but a long position on that toy. You have predetermined the price, you have predetermined the date, and you are long because you're going to go ahead and purchase that particular toy for your kid. That is known as a long position. Now, the inverse of that is nothing but a short position. So, what that shopkeeper has done is that he has gone short on his toy, which means he has agreed on a price, he has agreed on the underlying, he has agreed on the date when he will sell it to you, right? Now, this in very simple example is, I'd say, is how a long position and a short position works. Now, just to make it more more friendly and for you to work with numbers, I'll give you an example that say tomorrow the price of the toy goes up. Now, what happens? The shopkeeper has promised that he will sell you at a particular price, which means you tend to make a gain because when you go long on a position and the price goes up, you make a gain. So the shopkeeper has promised that he will give you that toy at a particular price. The price has gone up, but your price is locked at this number which you decided today. So you make a gain. Likewise, if the price went down to what you agreed upon, then the shopkeeper tends to make a gain. The reason being, the shopkeeper agreed to sell that to you at a price which is already determined. Now, 2 or 3 months, whatever that time period, you go ahead and buy the toy at the price which you are determining it today, and the price is lower, which means you are making a loss and the shopkeeper is making a gain. So, in very simple words, in a short position, in case the price goes down, the person makes a gain, and in a long position, in case the price goes up, the person makes a gain. So this is as simple as that. We had used linear curves, we had looked at payoff diagrams, but simply put, this is as simple a concept as this, from a very practical standpoint. I think that should be it for the time being, and let's move on to the final sort of snippet for the today's webinar, and then we will be moving into a short quiz.
Comparison between futures and forwards. We have covered this already, but no harm to look at it again. So a foreign exchange forward is an OTC contract, whereas a futures is something which gets traded on the exchanges. These are non-standardized forwards, whereas the futures are standardized in terms of size, expiry, so on and so forth. The price discovery, since this is bilateral, is based on negotiation of both parties, whereas for a currency future, this is to the interaction of all the buyers and sellers on the exchange. So this is determined by market forces. Liquidity is low because these are tailor-made contracts, whereas the liquidity is much higher here because these are standardized contracts, and there might be a party who might be interested to buy or sell over the course of time. Settlement is not guaranteed, and hence it's bilateral. They are physically settled. Because of the involvement of the clearing corporation over here, the settlements are guaranteed, and these are cash settled. These are some important points to be kept in mind, especially from a testing or the MCQ perspective. Let's look at the advantages and limitations to a futures and forwards contract. First of all, a forward, because they are a customized contract, will provide you with a perfect hedge. Uh, since these contracts are settled in kind, which is in currency, these are appropriate for importers and exporters when they have a need for hard currency. Operational aspects such as margin or mark to market is irrelevant here, because there's no exchange or there's no valuation which periodically happens to keep on tap on whether you are in the money, do you have enough liquidity, do you have enough credit worthiness to honor your contract. So operationally, yes, it is less cumbersome. But on the contrary, if you were to look at the limitations, then is one, you are taking counterparty risk because you're not sure whether the person might honor or might not honor. There's no mark to market. There's liquidity risk because once you get into these contracts, you cannot really come out of it. You have to work with the same person to cancel out the contract. So you cannot just uh, uh, take another position which is contrary to your current position. When you do that, you are opening yourself up to two forms of credit risk on each of those legs. So hence, it's not advised. This point goes back to the same point that there are limited market participants, which means there's going to be limited liquidity for either entering, or rather, in the words of the terminology which we just saw, for opening positions. And canceling and rebooking has to be done with the same specific party, which means it's a difficult process. Now, if you were to look at the advantages of futures, one is there's price transparency because this is a deep market, no counterparty credit risk because there's the clearing corporation involved in between. Various types of market participants have access to this particular futures instrument. Does not matter whether the participant over here is from what strata of the credit grading. The reason is there's a mark to market, and then there is margins, mark, mark to market, and margins to take care of. My pen isn't working well. Margins to take care of the credit worthiness. There's lower liquidity risk, which means in case you enter into this contract with some sort of impact cost, you can come out of it, you can sell off your stake or your position in that currency. Lower impact cost, what this means is the spread between buying and selling isn't huge, which means you do not, in case you want to open a position or close a position, the transaction cost or the cost to implement that trade in terms of the price gap isn't much, and easy entry and exit. But then on the contrary, these points might actually come up here. So let's have a look. Imperfect hedge, the first point here. Cash settlement requires separate spot prices. Now there's a linkage to the spot prices in that sense. So that's point number 2 over here, as you can see. And operational issues, so which is point number 3. So the advantages of a forward contract are not there with a futures contract, and this can also be labeled in some ways to be forward advantages, negation of forward advantages. Interest rate parity and its importance for pricing of future currency futures. I see there's a lot of mathematics here. I'll not get into it. I'll simply try and explain this concept in words, right? So I'll just put the pen aside. So now, say the currency, the risk-free rate in India is 8%, and the risk-free rate in US says 3%. So there's a 5% difference between the currency or the interest rates, risk-free interest rates in India and the US. So 8 and 3. Now, currencies should actually automatically adjust such that you are not making a gain by borrowing in one currency, investing that at the risk-free rate in the other currency, withdrawing from that currency, and paying back the borrowing that you have done in the first currency. In simple words, the Indian rupee should depreciate by 5% over the period, which is, if we are talking about per annum, it should depreciate by 5% because if the rate of interest is 8% per annum and 3% per annum in US, then the USD INR linkage to avoid any sort of interest rate arbitrage or interest rate, carry trades, the INR should be depreciating by 5% vis-a-vis the USD for the term in conversation over here, assuming say that's per annum. This concept of interest rate parity, which is the gap or the higher yield on your interest rates in one country, should offset by the depreciation of that currency where the yield was higher, is known as interest rate parity, and that's a relationship between the interest rates and the currency pricing for the future market. Let's look at these concepts in terms of currency at premium and currency at discount. So the same USD INR example, since the USD interest rate is lower than the INR interest rate, the relationship is such that the USD INR future should be more favorable, or rather USD appreciated vis-a-vis the USD INR spot. Simply put, the USD should be at a premium on a future date vis-a-vis the current spot date. Now, to look at another example around, say, currency at discount, the JPY interest rate is 0.25%, whereas the euro interest rate is 1%. Now, this implies that the euro is expected to be at a discount to JPY because the euro interest rate is actually higher than the JPY interest rate. So, simply put, the currency which has a higher interest rate will be or is expected to be at a discount on the futures rate because this would offset borrowing in a currency, investing in the higher yielding currency, and again withdrawing and repaying that currency off. That allows to knock off any sort of interest rate arbitrage opportunities which could exist. Theoretically, the future price can be determined based on the interest rate differential between the two currencies. What does that mean? Let's look at the formula here. So this formula here uses E. I'll not get into this. E is basically used for continuous compounding. We'll work with something which we have all looked at when we are looked at compounding of money. So I will say, let's say we want to know what would be the future value of money. You would start with principal. You would assume a rate of interest, and then you'll multiply it with T, given the number of years and so forth. The similar extrapolation of formula can be done for even the future pricing. So the future pricing, and let's work with the, say, the USD example that we had started off with. Future price will be nothing but the spot price And let's say that, we are finding the future price for 1 year down the line. So the spot price multiplied by 1 plus the risk-free in India minus the risk-free in US and multiplied by the tenor, which is 1 year. So in simple words, the expected future price or the mathematical future price, which would not allow for any arbitrage to happen over interest rates, is say 89 being the spot plus 1 plus 0.08 minus 0.03 multiplied by T year, which is a single year, just for the sake of simplicity. So the future price is nothing but 89 increased by 5%. And that becomes your future price, implied future price, or the future price, which is also known as a theoretical price computation, which does not allow for any interest rate arbitrage scenarios to exist in the currency markets. This brings us to an end of this chapter, so a little bit ahead of time. We'll get into a short quiz, and post that we will be picking up audience Q&A. So the quiz will be up on your screen. Please do attempt. We'll try and answer those questions. These questions are picked up from the NISM workbook, the module for your examinations, and we will look at those questions.
So while the quiz is live, and it's a short quiz, it's just a 3-question quiz, I also pick up some of the other questions which are there on the screen. So one is Sanjay. He says that whether forward contracts or forward transactions are the only ones which are available. Actually, see, futures are basically much more active because they are there on the exchanges. See, forwards are in a way nothing but a bipartite agreement between two people, not done on an exchange. So forwards in a way are a private futures. So hence they are customized and all of those things. A future basically gets traded, and we had looked at 3 concepts there. It gets traded, it gets used by hedgers, and it also gets used by arbitrageurs who find perhaps on exchanges or across various times if you have 2 different prices and they can try and make a small gain, right? That's what an arbitrager does. Arbitrager does not take a position, makes a small gain by squaring of the position very quickly. Or in the words of what we just saw, it's about opening a position and closing a position simultaneously and making a small gain. So Sanjay, the forward transactions do happen in the real world, but then the forward transactions are not done on the exchange. They are bipartite agreements. I see that you guys must have moved on to question number 3. I'll try to pick up one more question from the Q&A. And thank you. In case you don't, are not clear on any of the concepts, please keep sending those questions to us so that we can, talk a little bit more about that. Rahul, you have asked a question around interest rate future, but maybe please try and elaborate so that we can speak in detail about, a specific concept that you would like to hear from us. I see that there are a couple of questions on the recordings and so forth. Well, the recordings will be put up on our YouTube channel. As I mentioned, it's KFintech, KFintech, and they will also be posted onto our WhatsApp channel when we basically go live on YouTube. Some of you guys perhaps are not aware about our WhatsApp group. So when you go to could you take that off for a moment? We'll come to the questions in a bit. So when you go to your so this is how the KFintech WhatsApp group looks like. It's KFintech MFD community. It has 11,000 odd followers, and you can search it on when you go onto the status side onto the left hand side, you have the statuses in WhatsApp. Over there, you have channels, and you can search for KFintech's channel over there, and that should give you an understanding of all the various things which you are putting up, right from webinars on NISM 13 or practitioners' insights on what's happening within the market. We have conversations with AMCs regularly, and we also do physical events. So please do sort of follow that, and be in touch with us, and we'll be happy to provide you with all the resources. Additionally, on which exchange allowed to trade currency? So at the moment, it's both BSE and NSE which allow to trade in foreign currency. All right, we will now. Okay, there are two things. I think you're talking about which book or reference material we can refer. So I had touched this upon the third. In fact, in the first webinar, we are now in the third webinar. So there are three modules which are part of NISM 13. One of them is currency derivatives, the second one is equity derivatives, and the third one is interest rate derivatives. You can look up on on the NISM website for these modules, and you'll come across the three textbooks. We are trying to cover chapter by chapter everything that is essentially there in these three modules across this webinar series, which is going to be running till the first week of March. I keep seeing more questions coming in, so I'll try to pick up more of this. And when it comes to our LinkedIn, you can just search for KFintech. You will come across a community of 60,000 strong, and you can follow us over there. There's a question on how many questions are expected from currency derivatives. So while NISM has mentioned that these are the three modules that you need to sort of study, they have not mentioned how many questions will come in from each module. As an exam, you will have 150 questions, and you need to score 60 marks. 60%, sorry, which means 90 marks on that 150 questions in order to clear the examination. Currently, it's for everyone who, every single individual who passes, one of them also fails. So the pass rates are very close to 50% right now for this module. It's not one of the higher pass rate examinations, just to give you a quick, and that's the reason why we are doing these webinars, so that this helps you to, maybe try and clear the examination. All right, I think with this, we will move on to the questions. So maybe can we have the questions on the, screen, please? Yeah, great. So I think we covered all of this in the first, in the first snippet itself, the small video which we played. So it mentions that how is USD INR future settled. First of all, this question can have various variants. It could be USD INR, it could be Euro INR, so on and so forth. All currency trades in India are cash settled, right? So all currency futures are basically cash settled. You can have various variants which can come along, but just remember that currency in India is cash settled. And when I say cash settled, it means INR settled, because we are in India, and hence cash basically means INR over here. All right. Second one is which of the following is the trading day for Euro INR monthly futures contract? Is the last trading day. So yes, I think anyone who is part of the market for a long period of time from a derivative standpoint, 2 working days prior to the last business day is your last sort of business day of that expiry month. But now with the recent amendment which came in, so we are trying to incorporate the more of the news items as well, which we are collecting on our way. The Thursday, which was looked up initially, is going to be moved to Tuesday for all trades on NSE. And this is specifically for the equity segment and not for the currency segment, right? And third question, as we can see, it talks about GBP INR futures contract. And if you just look at some of the keywords there from a response standpoint, you should be able to quickly get to the answer. One is it is short. Second, it says GBP INR futures contract at 99.75. Now, and on expiry, the price is 100.75. So let's go back to what we discussed. In case of a short position, you make a gain when the price or the expiry price or the reference price at that time is lower. In this case, the price is higher, which means there is a loss because this is a short position, right? So what is the loss? It is nothing but 99.75 minus 100.75 gives you -1. So you have made a loss of 1 rupee, right? And that 1 rupee is on one single one single currency. Or what I mean is one single currency unit, which means if the contract size is 1000 GBP, then that one has to be multiplied by 1000 to give you the number, which is 1000 INR, right? But the textbook basically is ignoring the fact that a standard contract is 1000 GBP. And given all of these answers, we should just go ahead with, a loss of 1, right? So the textbook has not taken into account that a single contract on the exchange is 1000 GBP. So I think these are the 3 questions which we have gone through. I see a couple of more questions up there. One that, are there any sort of certificates or something which is provided by KFintech? No, so this entire initiative is basically to ensure and help you guys with your examination for NISM 13. KFintech does not provide any certificates. This is essentially content knowledge which we are trying to, put into the public resource for the ecosystem to benefit, right? And I think I just put up the WhatsApp channel onto the screen. You can search by that particular name, and these videos also will be put up shortly on to our YouTube channel. Our WhatsApp channel has all of this information that's put up on the screen. Great, thank you team for putting that up. Our WhatsApp channel is there on your screen. You can search for that. The YouTube channel is also mentioned. The recorded videos will be put up on the YouTube channel. So yeah, where can you get the reading material? You can get the reading material on NISM's website. And as I mentioned, this is a combination of three sort of modules in derivatives. One is your currency derivatives. The second one is your equity derivatives, and then your interest rate derivatives. I think that those were all the questions. And thank you very much for being with me through this particular hour. I hope we could at least bring some light around what exchange traded currency derivatives are, especially the futures aspect. We will be live onto our 4th webinar next year. But in the meanwhile, I'd like to wish all of you a very happy new year in advance. And we will look forward to hosting you again for our 4th webinar. Thank you very much, everyone.